While everyone was distracted by the political theater of tax cuts and the headlines screaming about bracket adjustments, a silent robbery occurred on January 1st, 2026. It was executed by the Social Security Administration with a single line item adjustment, buried deep in actuarial tables that 99% of Americans will never read. The crime was perfectly legal, mathematically elegant, and absolutely devastating to a specific class of earners, those making just enough to feel comfortable, but not enough to escape the machinery of the system. The number is $520.80. That is how much more the average six-figure earner will pay in FICA taxes this year compared to last year, despite no change in their salary, despite no change in the tax rate, and despite politicians promising tax relief. This is not a tax increase in the traditional sense. Congress didn't vote on it. The president didn't sign it. There were no town halls or debates. It simply appeared, as it does every year, adjusted for inflation like a thermostat cranking up the heat while you sleep. And if you earn between $176,000 and $184,000 this year, you are the target. This is the stealth taxation protocol. And by the time I finish this briefing, you will understand exactly how it works, who it benefits, why it is accelerating, and most importantly, what you can do about it before they come back for more next year. To understand how $520 vanished from your paycheck without a single law being passed, we need to examine the architecture of the Federal Insurance Contributions Act. The FICA is the payroll tax that funds Social Security and Medicare. Every time you look at your pay stub and see that line item labeled OASDI, old age, survivors, and disability insurance, that is Social Security. The adjacent line, HI, or hospital insurance, that is Medicare. The combined FICA rate is 7.65% for employees. That breaks down to 6.2% for Social Security and 1.45% for Medicare. Your employer matches this, paying another 7.65% for a total of 15.3% going into the system. If you are self-employed, you pay the full freight both sides, though you get to deduct half of it. Here's where it gets interesting. The Medicare portion, and that 1.45%, has no ceiling. Whether you make $50,000 or $50 million, you pay 1.45% on every dollar. But the Social Security portion, that 6.2%, has a cap. It is called the Social Security wage base. And in 2025, it was $176,100. Any dollar you earned above that threshold was exempt from the 6.2% Social Security tax. For 2026, that wage base has increased to $184,500. That is an $8,400 jump. And that means if you earn more than $176,000 this year, you are now paying Social Security tax on an additional $8,400 of income. Let's do the math. $8,400 multiplied by 6.2% equals $520.80. That is the additional tax burden per employee. If you're self-employed, double it. $1,041.60. Your employer, if you have one, is paying the exact same amount on your behalf. They just don't tell you about it because it doesn't show up on your W-2. But make no mistake, that is part of the cost of employing you, and it factors into hiring decisions, raise calculations, and layoff considerations. This is the hidden tax. It is not framed as a tax increase because technically the rate stayed the same, but the base expanded. More of your income is now subject to the tax. The result is identical to a rate hike, but it flies under the political radar because it is indexed to inflation and automatic. No politician has to defend it. No one campaigns against it. It simply happens. The Social Security Administration uses a formula to determine the annual wage base adjustment. It is tied to something called the National Average Wage Index, which tracks changes in average wages across the economy. When wages rise due to inflation or productivity gains, the wage base rises with them. The stated purpose is to ensure that the Social Security system remains solvent by capturing a consistent percentage of national income. On paper, this sounds reasonable. After all, if wages are rising, the cap should rise too, right? But here's the trap. The adjustment is not tied to your individual wage growth. It is tied to the national average. And in an economy where wage gains are concentrated at the top, where tech workers and finance professionals see double-digit salary increases, while service workers see 2 or 3%, the national average gets dragged upward by the winners. The result is that the wage base increases faster than the income of the median worker, but it captures more and more of the income of the upper middle class. Let's look at the velocity of this increase. From 2022 to 2023, the wage base jumped from $147,000 to $160,200. That is a $13,200 increase, the largest in the program's history. From 2023 to 2024, it jumped again to $168,600, an $8,400 increase. From 2024 to 2025, another $7,500 bump to $176,100. And now, from 2025 to 2026, another $8,400 to $184,500. In just 4 years, the wage base has increased by $37,500. If you have been earning at or above the cap throughout this period, you have been paying an additional $2,325 per year, every year, in escalating Social Security taxes. That is $9,300 over 4 years. Nearly $10,000 extracted from your income through a mechanism that requires no congressional approval, no signature from the president, and no debate on the floor. This is inflation indexing as a tax engine. It is automatic, it is compounding, and it is designed to be invisible. Now let's talk about bracket creep. This is the term economists use to describe what happens when your nominal income rises with inflation, but your purchasing power stays flat or even declines. You are making more dollars, but those dollars buy less. Meanwhile, you are being pushed into higher tax brackets, or in this case, having more of your income subjected to payroll taxes that were previously exempt. Imagine you earned $170,000 in 2025. You were below the wage base, so all of your income was subject to the 6.2% Social Security tax. Your total Social Security tax liability was $10,540. Now imagine you get a raise in 2026. Your employer gives you a 5% cost of living adjustment, bringing your salary to $178,500. Congratulations, you got a raise. But wait, in 2025, $170,000 times 6.2% equals $10,540 in Social Security tax. In 2026, $178,500 times 6.2% equals $11,067 in Social Security tax. That is an increase of $527 in Social Security taxes alone. But your raise was only $8,500 in gross income. After the additional Social Security tax, Medicare tax, federal income tax, and state income tax, that $8,500 raise might net you $4,000 or $5,000 in actual take-home pay. You got a 5% raise, but your standard of living increased by less than 3%. This is the bracket creep trap. Your employer thinks they are rewarding you. You think you're moving up, but the tax system is calibrated to intercept that upward mobility and siphon it off before it reaches your bank account. And here's the kicker. If you were already earning above $184,500, you don't experience this bracket creep at all. Once your income exceeds the wage base, every additional dollar is exempt from Social Security tax. So if you make $300,000 or $3 million, your Social Security tax burden is capped at $11,439 in 2026. The marginal rate above that threshold for Social Security purposes is 0. The system is regressive at the top. It punishes the climb, but rewards those who have already reached the summit. Let's be forensically specific about who is affected by this stealth tax and who escapes. According to the Social Security Administration's own data, only about 6% of covered workers earn income at or above the wage base in any given year. 6%, that is roughly 10 million people out of 170 million workers. These are not billionaires. These are not private equity partners or hedge fund managers. These are senior engineers at tech companies, experienced doctors and dentists, mid-level corporate executives, successful small business owners, and dual income households, where both spouses are professionals. A household where one spouse is a senior software engineer making $190,000, and the other is a nurse practitioner making $110,000, has a combined income of $300,000. They are solidly upper middle class in most cities, especially expensive coastal metros, but they are not rich. They are paying mortgages, daycare, student loans, and saving for retirement, and both of them are paying maximum Social Security taxes, $11,439 each. $22,878 combined, just for Social Security. Add in Medicare, and their combined FICA burden is over $30,000 per year. Meanwhile, someone earning $5 million a year pays the exact same $11,439 in Social Security tax as the software engineer. The nurse practitioner pays $11,439 on her $110,000 income, a 10.4% effective rate. The $5 million earner pays $11,439 on $5 million, an effective rate of 0.23%. This is the regressive ceiling in action. Now, proponents of the current system argue that this is by design. Social Security is meant to be an insurance program, not a wealth redistribution scheme. You pay in up to a certain amount, and you receive benefits capped at a certain level. The theory is that because high earners receive proportionally less benefit relative to their contributions, the cap is justified. But this logic collapses when you examine the reality of the trust fund's solvency crisis. The Social Security Board of Trustees projects that the trust fund will be depleted by 2033. When that happens, the system will only be able to pay out 77% of scheduled benefits using incoming payroll taxes. To prevent this, policymakers have three options: cut benefits, raise the retirement age, or raise taxes. Guess which one is happening right now, quietly, automatically every single year? The wage base increases are a stealth tax hike on the upper middle class, designed to extend the solvency of the system without requiring Congress to take a politically toxic vote. It is a slow-motion bailout funded by the people who are least able to organize politically because they are too busy working. If the FICA creep is painful for W-2 employees, it is catastrophic for the self-employed. When you work for an employer, you pay 6.2% in Social Security tax and 1.45% in Medicare tax, and your employer matches it. You see half the cost on your pay stub. The other half is invisible to you, though it is part of your total compensation. When you are self-employed, running a consulting business, freelancing, operating a sole proprietorship, you pay both sides. You are the employee and the employer. That means you pay 12.4% for Social Security and 2.9% for Medicare, for a total self-employment tax of 15.3% before you even calculate your income tax liability. Let's run the numbers for a self-employed consultant who earned $180,000 in 2026. Their Social Security tax is calculated on the full $184,500 wage base, even though they only earned $180,000. Wait, no, let me correct that. They pay Social Security tax on $180,000 times 12.4%, which equals $22,320. But here's the nuance. The IRS allows you to deduct half of your self-employment tax to arrive at your adjusted gross income. So you pay $22,320 in self-employment tax for Social Security, but you can deduct $11,160, reducing your taxable income for income tax purposes. However, that deduction does not reduce your self-employment tax liability. You still pay the full $22,320. The deduction only reduces your income tax, which is calculated after the self-employment tax is paid. This is the double hit. You pay more than a W-2 employee, and you get a partial deduction that only softens the income tax blow, not the payroll tax blow. For a self-employed person earning at the wage-based cap, the 2026 increase from $176,100 to $184,500 means an additional $1,041.60 in self-employment tax, double the W-2 burden. And this comes at a time when inflation is eating into margins, when interest rates are making it harder to finance operations, and when clients are cutting budgets. The self-employed are getting squeezed from every direction, and the FICA ceiling is rising faster than their ability to raise prices. To understand where this is heading, we need to look at the historical trajectory of the wage base. In 1980, the Social Security wage base was $25,900. Let me repeat that, $25,900. If you earned $26,000 in 1980, you paid Social Security tax on $25,900 of it, and the rest was exempt. Fast forward to today, and the wage base is $184,500. That is an increase of 713% over 46 years. Now let's compare that to inflation. According to the Bureau of Labor Statistics, the cumulative inflation from 1980 to 2026 is approximately 293%. Prices have roughly tripled, but the Social Security wage base has increased by 7 times. It has grown more than twice as fast as inflation. Why? Because the wage base is indexed to wage growth, not price inflation. And wage growth, especially at the top of the income distribution, has far outpaced price inflation over the last 4 decades. The result is that a larger and larger share of national income is being subjected to the Social Security tax, and the people bearing that burden are the professional class, the small business owners, the entrepreneurs, the upper middle class, the people who do not qualify for means-tested benefits, who do not get subsidies, who do not get bailouts, but who are too visible to the IRS to evade taxes. This is the acceleration trap. The wage base is not just rising with inflation, it is rising with wage inequality. And as long as the top 20% of earners continue to see wage gains, while the bottom 80% stagnate, the wage base will continue to rise faster than the cost of living, pulling more and more people into the maximum tax bracket. Here's a wrinkle that almost nobody talks about. The Social Security wage base creates a compliance burden for employers, especially small businesses. Every payroll system in America has to be programmed to track each employee's year-to-date wages and stop withholding Social Security tax once they hit the cap. This is not a trivial task. Payroll software companies have to update their systems every year to reflect the new wage base. Accounting departments have to monitor multiple employees who might hit the cap at different times during the year. And if you have multiple jobs, the situation becomes even more complex. Let's say you work 2 part-time jobs, each paying $100,000 per year. Each employer withholds Social Security tax on your full salary because, from their perspective, you are below the wage base. But your combined income is $200,000, which exceeds the cap. You have overpaid Social Security tax by the amount that exceeds the wage base. You can claim a refund when you file your tax return, but you have to know to do it. The IRS does not automatically flag this. You have to calculate it yourself, file the form, and wait for the refund. This creates a cash flow problem for workers who are already stretched thin. You overpay throughout the year, and you get the money back months later, interest-free. Meanwhile, the government has been holding your money, using it to fund current benefits, and you have lost the time value of that capital. For someone who is self-employed and making estimated tax payments quarterly, this can create a significant liquidity crunch. Why does this tax increase persist year after year without political pushback? Because it has the perfect invisibility shield. It is automatic, tied to a technical index that most people do not understand. It affects only 6% of workers, and that 6% is distributed across all 50 states, all industries, and all political affiliations. There is no single voting bloc to organize around this issue. The people it affects most are also the people who are least likely to complain loudly because they are still relatively well off. They are not poor enough to be politically sympathetic, and they are not rich enough to hire lobbyists. Furthermore, any politician who proposes eliminating the wage-based cap entirely faces a backlash from exactly the same group. There is a contingent of progressives who argue that the wage base should be abolished, that every dollar of income should be subject to Social Security tax, no cap at all. They frame this as a way to save Social Security and make the system more equitable. But for the people currently earning between $184,500 and $500,000, this would be devastating. It would turn the 6.2% marginal rate into a permanent fixture of their tax burden, adding tens of thousands of dollars per year in additional taxes. So the political dynamic is perfectly calibrated. The upper middle class does not want the cap eliminated, so they do not push to reform the system. The lower and middle class do not hit the cap, so they do not care about the annual increases. And the truly wealthy, the top 1% earning millions per year, have already hit the cap in January, so the annual adjustment is irrelevant to them. Everyone is locked in place, and the machinery keeps grinding. So what do? You cannot opt out of FICA. It is mandatory. There is no legal way to avoid it, short of not earning income, which is not a viable strategy for most people. But there are tactical adjustments you can make to minimize the impact and position yourself for the long-term reality of an ever-increasing wage base. Protocol Rule 1. Maximize tax-advantaged retirement contributions. If you are a W-2 employee, contribute the maximum to your 401k. In 2026, the limit is $23,500, plus an additional $7,500 if you are over 50. This reduces your taxable income for federal and state income tax purposes. It does not reduce your FICA liability. FICA is calculated on gross wages before retirement contributions. But it reduces your overall tax burden, giving you more control over your money. If you are self-employed, set up a solo 401k or a SEP IRA. The contribution limits are much higher for the self-employed, up to $69,000 in 2026. You can deduct these contributions, reducing your adjusted gross income and, critically, reducing your self-employment tax base. This is one of the few ways to legally reduce your FICA liability as a self-employed person. Protocol Rule 2. Shift income to capital gains. FICA only applies to earned income, wages, salaries, and self-employment income. It does not apply to investment income, capital gains, dividends, or interest. If you are in a position to structure your compensation as equity rather than salary, you can reduce your FICA burden. This is how executives at public companies manage to pay lower effective tax rates than their secretaries. They take a modest salary and the rest of their compensation in stock options or restricted stock units, which are taxed as capital gains when sold, not as wages. Obviously, this is not an option for most people. But if you own a business, you can pay yourself a reasonable salary, subject to FICA, and take the rest of your income as distributions or dividends, which are not subject to FICA. The IRS scrutinizes this heavily, so you need to pay yourself a salary that reflects the market rate for your role, but anything above that can be structured as a distribution. This is how S-Corp owners save tens of thousands of dollars per year in payroll taxes. Protocol Rule 3. Plan for the escalation. The wage base is going to keep rising. If historical trends continue, it will hit $200,000 by 2028 and $250,000 by 2032. If you are in your 30s or 40s and climbing the income ladder, you need to assume that your FICA burden will increase every year. Even if your salary does not, budget for it. Do not count on that 5% raise translating to a 5% increase in take-home pay. After FICA, Medicare, federal, state, and local taxes, you might see a 2 or 3% increase. Plan accordingly. Protocol Rule 4. Understand the benefit calculation. Here is the bitter irony. You are paying maximum Social Security taxes, but you will not receive maximum Social Security benefits relative to your contributions. Social Security benefits are calculated using a progressive formula that replaces a higher percentage of income for low earners than for high earners. If you earn at the wage base throughout your career, you will receive the maximum monthly benefit in retirement, currently about $5,251 per month in 2026. But that maximum benefit replaces only about 25 to 30% of your pre-retirement income. For someone earning $50,000 per year, Social Security replaces about 40 to 50% of their income. The system is designed to be regressive at the top. You pay more, but you get proportionally less. Does this mean you should not pay into the system? No, it is mandatory. But it does mean you should not count on Social Security to fund your retirement. If you are earning above the wage base, you need to be saving aggressively in private retirement accounts because Social Security will not maintain your standard of living. It will be a supplement, not a primary income source. Protocol Rule 5. Vote with your feet. This is the nuclear option, but it is worth mentioning. 7 states have no state income tax: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming. 2 more, New Hampshire and Washington, have no tax on earned income, but do tax investment income. If you are self-employed or can work remotely, relocating to one of these states can save you thousands of dollars per year in state income tax. It does not reduce your FICA burden, but it reduces your overall tax liability, giving you more capital to invest and build wealth. Furthermore, an increasing number of high-income professionals are exploring expatriation, moving to countries with lower tax burdens and better cost of living. This is not for everyone. It requires significant life changes and comes with its own complications: IRS reporting requirements for foreign income, expatriation taxes if you renounce citizenship. But for someone earning $200,000 or more per year, the tax arbitrage can be substantial. Countries like Portugal, Singapore, and the UAE offer favorable tax treatment for high earners, and the rise of remote work has made geographic arbitrage more feasible than ever. Let's talk about where this all leads. The Social Security Trust Fund is projected to be depleted by 2033. When that happens, the program will face a 23% shortfall. To close that gap, lawmakers will have one of 3 choices: cut benefits by 23%, raise the retirement age to 70, or raise taxes. Given the political sensitivity of cutting benefits and the demographic reality that Americans are living longer but not necessarily healthier, the most likely outcome is a combination of modest benefit cuts and significant tax increases. The wage base will continue to rise, but that alone will not be enough. At some point, Congress will have to consider more drastic measures: eliminating the wage base cap entirely, increasing the FICA tax rate, applying FICA to investment income. Each of these options would represent a massive tax increase on the professional class, the small business owners, the people who are currently bearing the brunt of the stealth tax increases. There is also a darker scenario that few are willing to discuss publicly. What if the trust fund depletion is not accidental but intentional? What if the automatic wage base increases are designed to extract maximum revenue from the upper middle class while maintaining the political fiction that benefits are secure? The system is structured so that the people paying the most into it have the least political power to change it, while the people receiving the most from it have the most political power to protect it. This is not a sustainable equilibrium. Something will break. Either benefits will be cut, or taxes will be raised, or the trust fund will be bailed out with general revenue, turning Social Security into just another welfare program. Any of these outcomes represents a betrayal of the original social compact that Social Security was built on. The promise was simple. You pay into the system throughout your working life, and you receive a dignified retirement benefit based on your contributions. But that promise is being diluted year by year, dollar by dollar, through the mechanism of the rising wage base. You are paying more, and you will receive proportionally less. The system is becoming a transfer program, taking from the productive to fund the retired, with no guarantee that the productive will receive the same benefits when their turn comes. The $520 increase you saw in your paycheck on January 1st was not an anomaly. It was not a glitch. It was the system working exactly as designed, extracting more revenue from the people who can least afford to fight back politically. And it will happen again next year, and the year after that, and every year until the system either collapses or is fundamentally reformed. The archivist protocol is simple. Understand the mechanism. Accept that it is not going to change through normal political channels. Adapt your financial strategy to account for the ongoing extraction. Maximize tax-advantaged savings. Shift income to capital gains where possible. Plan for escalation. And recognize that Social Security for high earners is a tax, not a benefit. You are funding someone else's retirement, and you should plan your own retirement as if Social Security did not exist. Because by the time you are ready to claim it, it might not, at least not in its current form. The hidden tax is no longer hidden. You see it now, $520 this year, more next year. The only question is, what are you going to do about it?